Earnings season is just getting going. Here to offer his thoughts on what we've seen so far is Steve Sachs from ProShares. Welcome, Steve.
Glad to be here.
It's good to have you back. Now tell me, what do you think of what we've seen from earnings so far? I know Alcoa just kicked it off, but right now people still seem to be focusing on Ben Bernanke.
Yeah, no, they are definitely. I mean, particularly in the last 24 hours, obviously, it's been all about the Fed and Ben. That'll change. It'll change quickly. It'll change over the next couple of days to a week. As you said, Alcoa just started out. Earnings season this time around, pretty low expectations. Comps aren't that tough. Expectations and earnings estimates weren't adjusted that much coming into the quarter. Keep an eye on top line revenue growth. It was a story last quarter. It's going to be the story in the back half of this year. Everybody's fairly comfortable with the way companies are managing margins and balance sheets these days. What people want to see now is the slow growth that we're seeing here in the U.S. Is it hurting top line revenue growth?
So there's no more cost to cut that will boost the bottom line.
There's always cost to cut. You can always do things.
That's
particularly
people.
Right. That's people. Exactly. Particularly in financial services and tech and telecom. There's always cost to be cut. But again, what people want to see now, what the analysts want to see now, what fundamental investors want to see now is there demand? Are there people out there buying the products that companies are making, and is it growing top line revenue? Because that's what's ultimately going to translate into better earnings down the road and leverage the cost cuts that we've already seen in corporate America.
All right, one thing that we've seen in the past month is that a lot of yield-based securities, especially in the ETF realm, have sold off. They've come back a little bit as rates have spiked and have eased back a little bit. So is it safe to get back into MLPs and REITs and a lot of those fun ETFs that ProShares puts out?
It's a great question. It all depends on your time frame. I mean, right? Given what we're seeing in the rate environment, we think that we're seeing a regime shift in the interest rate environment. Rates are going higher. They're probably going higher, consistently or sooner versus later. Those interest rate sensitive, equities sectors as well as products, it depends on what your time frame is. If you need yield, and a lot of people do, and your time frame is a long-term time frame, you're okay. If you're more of a tactical trader, you're probably going to still see some more pain there in the interest rate sensitive trade.
Now, a lot of commodity-based ETFs, and there's a lot out there, have been selling off over the past 6 or 7 months as we've seen soybeans come down, corn come down, the precious metals come down. Oil's going up a little bit, but we'll leave that one aside. So is it safe to get back into the commodity ETFs?
We've actually seen more interest, if you will, and interest in the form of conversations, particularly as it relates to inflation. So one of the things that we talk a lot about to our client base, which is, are institutional clients and financial professionals, is the balance sheet unwinding that the Fed needs to do. What's the long-term effect of that from an inflationary perspective? So there's really two themes playing out. There's the commodity and inflation trade and the break-even inflation trade, which we think is something that actually, takes place over the back half of the year and into next year, and it's the interest rate, trade. One of the things that we've recently done at ProShares is launched HYHG, which is the ProShares High Yield Interest Rate Hedged Portfolio. It's an alternative fund that effectively takes the duration risk or your interest rate risk out of your high yield portfolio. You can hold the portfolio of high yield bonds, still get the income, but not have to worry about the detrimental effects of a rising rate environment.
Well, high yield has certainly sold off, but come back. With regard to ProShares ETFs, though, they took a lot of heat maybe 3 or 4 years ago when everyone was getting on the case of leveraged ETFs, whether it be 1.5 times, 2 times, 2.5, 3 times. It seems like that's died down recently. Why is that?
It has. Education. One of the things that we, as well as the other ETF, sponsors in the industry, and not just, the leverage and inverse or the geared providers, but really the industry as a whole, has done a great job of educating investors and making sure that they have the information and the materials they need to understand what it is that they're buying. You also have to realize that, as with any bear market, when we go through a financial crisis in this country or any other, you're going to look for reasons or things to blame. And the fact of the matter is that ETFs in general have taken a bit of a bad rap because of market structure and things like that. But it really boils down to education, because it really has improved greatly from the ETF industry perspective, and it's helped individual clients and financial professionals understand what they own and how to use the tools.
Well, the pros are certainly using ProShares, right?
They are. It's the core of our client base.
All right. Thanks a lot, Steve.
Thank you.
Thank you for watching The Street.